Let me now focus on the substance of our hearing. Although the recently released report on the events of May 6th was quite thorough and thoughtful, the length of time it took to complete is an issue. What tools do our regulators need so that they can understand what is happening in our capital markets when it is happening, or at least very shortly thereafter? And that's, I think, one of the first issues. What resources do you need to effectively surveil and oversee our capital markets, particularly markets that are evolving at such a tremendous rate given technology? In the report, the SEC and the CFTC reconstruct the events that took place across a myriad of securities and future markets on May 6th, and I think that's a very important point. The interrelated aspect of securities markets, of CFTC product markets, are such now that something happening in one market cannot be easily isolated. According to the report, a single trade by a mutual fund was the primary cause of the chain of events that led to the volatile swings in the capital markets on May 6th. In effect, a CFTC-regulated product produced significant impacts within SEC-regulated equity markets, and I'm sure the opposite could occur under the right, unfortunately, right circumstances. Even before the plunge, the markets were already stressed and showing high volatility due to mounting concerns over the debt crisis in Europe on that particular day. According to the report, it was against this backdrop and a Dow Jones average that was already down about 2.5% that the mutual fund initiated an automated algorithmic trading program to sell $4.1 billion worth of E-muni futures contracts, which tracked the Standard & Poor's 500 stock index. In essence, the interaction of this one mutual fund's trading algorithm with the trading algorithms of other market participants, particularly high-frequency traders, seemed to have created a vicious feedback loop that increasingly accelerated the rate in which the orders were executed. In the end, this one trade sold in a span of 20 minutes. It was the largest single trade in E-mini futures since the start of the year. The net effect of this order was to send panic into the marketplace. How could one order by one trader do this? That's certainly an issue. How do we stop this from happening again? The events of May 6th bring into sharp focus concerns about the efficiency, stability, and integrity of our capital markets and the current structure of these markets. The existing structure of the U.S. equity markets is governed by a series of rules and regulations collectively known as Regulation National Market System, or Reg NMS. One of the questions before us today is, how does Reg NMS need to be updated to modernize and strengthen the national market system for equity securities for the 21st century? In addition to the January 2010 concept released by the SEC, again, let me commend you, Chairman Shapiro, and Chairman Gensler, for working on these issues proactively. On possible revisions to the Reg NMS, the SEC has responded with specific regulatory actions related to market structure and trading since May 6th, such as the institution of a stock-by-stock circuit breaker pilot program. We hope that today's hearing will help us understand some of the regulators' recent proposals and answer some of the other important questions as well. These questions are long, but let me suggest a few. What does the May 6th flash crash tell us about the stability and vulnerability of the U.S. capital markets? And to what extent, if any, can the May 6th problems be attributed to the current fragmentation market structure and interconnectedness between the futures, options, bond, and equity markets? What effects do technology-driven trading practices have on the stability and integrity of U.S. capital markets? What type of information, tools, and authorities do regulators need for the effective supervision of the capital markets? How can they more actively police across both products and trading venues? What are effective strategies for minimizing future market dysfunctions like the May 6th event and for minimizing market abuses caused by technology-driven trading practices? What are the effects of current market structure and trading practices on long-term capital formation in U.S. markets, and as a consequence, the health and vitality of the U.S. economy more generally? We look forward to hearing your testimony on all these topics, and I think I've just probably listed just a few of the questions that you've been dealing with quite diligently over the several months. Clearly, the cops on the beat, the SEC, the CFTC, need to have the same tools and resources as the traders so that they can police capital markets effectively. I will close by an old saying, by the great New England poet Robert Frost, good walls make good neighbors. You're the folks that build the walls and make sure the neighbors behave. And so we hope you can keep doing that. Now I'd like to recognize Chairman Levin.
Well, today, U.S. capital markets, which traditionally have been the envy of the world, are fractured. They're vulnerable to system failures and trading abuses, and they're operating with oversight blind spots. The very markets that we rely on to jumpstart our economy and invest in America's future are susceptible to market dysfunctions that jeopardize investor confidence. I want to begin by thanking Chairman Jack Reed, his ranking member, Senator Bunning, our colleagues on their subcommittee, the Securities, Insurance, and Investment Subcommittee, who have already held hearings on these issues. We thank them for welcoming our subcommittee, including our newest member, Senator Coons, to join with them today to shine a light on problems that threaten U.S. market stability and integrity. The first fact that we need to grapple with is that our markets have changed enormously in the last 5 years. In the past, most U.S.-listed stocks were traded on the New York Stock Exchange or the NASDAQ. 7 years ago, the New York Stock Exchange alone accounted for about 80% of the trades in its listed stocks. But today, less than 25% of the New York Stock Exchange listed stocks are traded there. What happened is a chart which we will put up here. Exhibit 1 shows the U.S. stock market has fractured. Stock trading now takes place not on 1 or 2, but on 13 stock exchanges, as well as multiple off-exchange trading venues, including 3 electronic communication networks, 36 so-called dark pools, and over 200 registered broker-dealer internalizers. Now, those off-exchange trading venues may need some more explanation. Electronic communication networks, or ECNs, are computerized networks that enable their participants to post public quotes to buy or sell stock without going through a formal exchange. Dark pools, by contrast, are electronic networks that are closed to the public and allow pool members to buy and sell stock without fully disclosing to each other either their identities or the details of their prospective trades. A broker-dealer internalizer is a system set up by a regulated broker-dealer to execute trades with or among its own clients without sending those trades outside of the firm. These off-exchange venues are increasing their trading volumes. Most use high-speed electronic trading, and they escape much of the regulation that applies to formal exchanges. These new trading venues didn't appear out of thin air. They are largely the result of Regulation NMS, which the SEC issued in 2005. Some call the resulting new world of on- and off-exchange trading a model of competition. Others call it a free-for-all that defies oversight and is ripe for system failures and trading abuses. In reality, both descriptions have some truth. Trading competition has led to lower trading costs and faster trading, but it has also opened the door to new problems. One of those problems involves system failures, of which the May 6, 2010 flash crash is the most famous recent example. On that day, out of the blue, the futures market suddenly collapsed and dragged the Dow Jones Industrial Average down nearly 700 points, wiping out billions of dollars of value in a few minutes for no apparent reason. Both the futures and stock markets recovered in less than 20 minutes, but left investors and traders in shock. After 5 months of study, a joint CFTC-SEC report has concluded that the crash was essentially triggered by one large sell order placed in a volatile futures market using an algorithm that set off a cascade of out-of-control computerized trading in futures, equities, and options. That one futures order, placed at the wrong time, in the wrong way, set off a chain reaction that damaged confidence in U.S. financial markets. In some ways, the May 6 crash was a high-speed version of the 1987 market crash, where a sudden decline in the futures market led to a corresponding collapse in the broad stock market, which led in turn to crashes in individual stocks. And it is not the only type of system failure affecting our financial markets. So-called mini-flash crashes, in which one stock suddenly plummets in value for no apparent reason, have become commonplace. On June 2, 2010, for example, shares in Diebold Inc., a large Ohio corporation, suddenly dropped from about $28 to $18 per share. The stock recovered, but the company was left trying to understand and explain what happened. Even after the SEC initiated a pilot circuit breaker program after the May 6 crash, at least 15 other companies have had similar experiences, including Nucor, Intel, and Cisco. A former senior NASDAQ executive told the subcommittee that the NASDAQ exchange has experienced single stock flash crashes 5 times per week. The New York Stock Exchange and FINRA told us these crashes are commonplace and attribute them to various glitches in computerized trading programs. Single stock crashes might seem to be a minor problem, but what happens if the security that crashes is a basket of stocks or commodities? On November 29, 2010, 3 of the top 5 equities traded by volume were actually baskets of stocks. If a basket of stocks or commodities crashes in value, what happens to the underlying financial instruments? Uncontrolled electronic trading and cascading price declines in multiple trading venues, including in futures, options, and equities markets, could be the result. In other words, another May 6th. Many investors, by the way, are not waiting around to find out if our regulators have fixed the problem. According to the Investment Company Institute, each month since May, more investors have fled our markets, pulling billions of dollars of U.S. investments. System failures are not the only problem raised by our fractured markets. Another problem is their increased vulnerability to trading abuses. Traders today buy and sell stock on and off exchange, simultaneously trading in multiple venues. Traders have told my subcommittee that orders in some stock venues are being used to affect prices in other stock venues, and that futures trades on the CFTC regulated markets are being used to affect prices on SEC regulated option and stock markets. Some traders are also using high-speed trading programs to execute their strategies, sometimes submitting and then canceling thousands of phony orders to affect prices. To get a sense of the trading activity that goes on today, take a look at this stack of paper. This stack, nearly 5 inches high, contains the actual message traffic generated in the futures, options, and equity markets with respect to one major U.S. stock over the course of 1 second. One stock in 1 second produced over 29,000 orders, order modifications, order executions, and cancellations in all 3 markets, by the way. Now, this stack shows in black and white how traders are now analyzing trades in all 3 markets at once, evidencing how the futures, options, and equity markets are interconnected. Imagine the same stack multiplied countless times, filling this entire hearing room, and the interconnectedness of the markets, as well as the potential for system failures and trading abuses becoming alarmingly clear. One well-known trader, Carl Denninger, recently made this public comment about U.S. trading activity. Folks, this crap is totally out of hand, he said, and it's now a daily game that's being played by the machines, which are the only things that can react with this sort of speed, and they're guaranteed to screw you, the average investor or trader. Go ahead, he said, keep thinking you can invest. Now, while fractured markets are high-speed, While fractured markets and high-speed trading are causing new problems and forms of manipulation, they are also leaving our regulators far behind. Traders are equipped today with the latest, fastest technology. Our regulators are riding the equivalent of mopeds going 20 miles per hour, chasing traders whose cars are going 100 miles per hour. Our regulators are confronting at least 4 challenges, and before I go through those challenges, I want to join Chairman Reid in congratulating and thanking our witnesses here today. You have led your agencies in important new directions and reforms, and you're doing it with, I think, great professionalism and talent, and we are commending of the efforts that you are making. Here are some of the challenges that our regulators are facing. The first is the fact that each trading venue today has its own infrastructure, rules, and surveillance practices. Besides the expense and inefficiency involved, no regulatory agency has a complete collection of trade data from all the venues, much less a single integrated data flow, allowing regulators to see how orders and trades in one venue may affect prices in another. Second, even if regulators had an integrated data flow, the current data systems fail to identify key information, including the names of the executing broker and customer making the trades. That means that regulators can't use the electronic records to, for instance, trace trading by one person or set up alerts to flag trades. Instead, before any trading analysis can start, regulators have to figure out the broker and customer behind each trade. Patterns of manipulation are hidden. The third problem is that the SEC has no minimum standards for automated market surveillance by self-regulatory organizations, so-called SROs. And the quality of those efforts is apparently all over the map. Recent SEC examinations of certain exchanges have found, for example, some ineffective surveillance systems that were unable to detect basic manipulations or used such restrictive criteria that they failed to flag suspect activity, exchanges that failed to review some surveillance alerts, and exchanges with only rudimentary or under-budgeted investigative, examination, and enforcement programs. The fourth problem is that the SEC and CFTC have not set up procedures to coordinate their screening of market data to see if trades in one agency's markets are affecting prices in the other markets. Given the strong relationships between the futures, options, and equities markets, joint measures to detect intermarket trading abuses are essential. The impact of the regulatory and technology barriers is demonstrated by the fact that it took the CFTC and the SEC 5 months of intense work to figure out what happened over a few minutes on May 6th, and I believe that Chairman Reid made the same reference. In addition, over the past 5 years, there have been few meaningful single-day price manipulation cases. One recent case involves a small trading firm, Trillium Trading LLC, which apparently used phony trading orders to bid up the price of several stocks. In that case, FINRA found that over a 3-month period in 2006 and 2007, Trillium submitted phony orders in over 46,000 manipulations, netting gains of about $575,000. Apparently, the victims of the price manipulation got annoyed enough to research the manipulative trading and hand over the data to FINRA. Even then, it took FINRA 4 years to reconstruct the order books, prove who was behind the trades, and resolve the matter. And Trillium and its executives recently settled the case by agreeing to pay fines and disgorgements. Traders and regulators have told us that Trillium is not the only company that is engaged in or is engaging in, either has engaged or is engaging in price manipulation in U.S. financial markets. In fact, one of the more chilling examples involves suspect trading involving traders located in China. Are overseas traders trying to manipulate U.S. stocks? Our regulators are currently ill-equipped to find out. May 6th flash crash in the Trillium case provide powerful warnings that we need to strengthen U.S. oversight of our financial markets to restore investor confidence. Much needs to be done. Recent actions by the SEC to prohibit phony quotes, impose single-issue circuit breakers, and set up a consolidated auto trail are important advances. But there's a long, long way to go, particularly with respect to coordinating market protections and surveillance across market venues and across the futures, options, and equities markets. There also needs to be a greater sense of urgency. The SEC's proposed consolidated audit trail is expected to take years to put into place and won't cover all of the relevant products and markets. Requiring executing broker and customer information, an essential component to effective oversight, is in limbo, pending completion of the consolidated audit trail, as is integrating the trade data from multiple trading venues. Integrating trading data and market surveillance of futures, options, and equities markets by the CFTC and SEC isn't even on the drawing board. I hope this hearing will help inject greater urgency into strengthening U.S. oversight of our fractured, high-speed markets to restore investor confidence. And again, I want to thank you, Chairman Reid, for holding these hearings and for the kind of leadership that you have shown in digging into these kind of issues over the years. Thank you.
Thank you very much, Mr. Chairman. And let me introduce our witnesses. Our first witness is the Honorable Mary Shapiro, Chairman of the Securities and Exchange Commission. Prior to becoming the SEC Chairman, she was the CEO of the Financial Industry Regulatory Authority, FINRA, the largest non-governmental regulator for all securities firms doing business with the United States public. Chairman Shapiro previously served as a commissioner of the SEC from December 1988 to October 1994, and then as chairman of the Commodities Futures Trading Commission from 1994 until 1996. Our second witness is the Honorable Gary Gensler, the chairman of the Commodities Futures Trading Commission. He previously served as the U.S. Department of Treasury as the Undersecretary of Domestic Finance from 1999 to 2000, and as Assistant Secretary of Financial Markets from 1997 to 1999. Prior to joining the Department of Treasury, Chairman Gensler worked for 18 years at Goldman Sachs, most recently as a partner and co-head of finance. Before you begin your testimony, let me turn it over to Chairman Levin to administer the oath pursuant to Rule 6 of the Rules of Procedure of the Senate Permanent Committee on Investigations. Would you please stand?
Thank you very much, Chairman Reid. As he said, pursuant to the rules of our subcommittee, all witnesses need to be sworn. Do you solemnly swear, if you'd raise your hands, that the testimony that you will give before these subcommittees will be the truth, the whole truth, and nothing but the truth, so help you God? Thank you.
Chairman Shapiro, you may begin.
Thank you for the opportunity to testify on behalf of the Securities and Exchange Commission concerning the U.S. equity market structure. When we discuss market structure, we're talking about everything from the organization of a market to the number and types of venues that trade a financial product, and we are talking about the rules by which those markets operate. Although these issues can be complex and the rules arcane, a stable, fair, and efficient structure is the backbone of the equity markets and an important engine of our economy. Keeping that backbone strong means responding to the ongoing dramatic changes that are reshaping our financial markets. A decade ago, most of the volume in stocks was executed manually. Now, nearly all orders are executed by fully automated systems, often in less than 1,000th of a second. And as you've mentioned, just 5 years ago, the New York Stock Exchange executed about 80% of the volume in the U.S. equities it listed. Today, it executes about a quarter of that volume. The remainder is split among 13 public exchanges, more than 30 dark pools, 3 ECNs, and more than 200 internalizing broker-dealers. And about 30% is executed in venues that do not display their liquidity or make it generally available to the public. At the SEC, we know that we must keep pace with the changing landscape of our securities markets. That is why more than a year ago, we initiated a thorough review of equity market structure. As part of that review, we've received hundreds of public comments, some emphasizing the benefit of today's structure and others raising concerns. We have heard how our current market structure fosters competition among trading venues and liquidity providers, lowering spreads and brokerage commissions. We have heard about the benefits of highly interconnected markets and have been cautioned about regulatory changes that might have unintended consequences. But on the other hand, we have also heard deep concerns about the quality of price discovery and whether the current market structure offers a level playing field on which all investors can participate meaningfully and fairly. As we consider regulatory responses, the Commission will evaluate these issues with a particular focus on obtaining the appropriate data and analysis to support our next steps. We will ask whether the changes we consider will aid capital formation and investor protection, enhance competition and price discovery, and improve inspection, surveillance, and enforcement. In this context, the prism through which I will view the role of market professionals, whether they are exchanges or ATSs, broker-dealers or high-frequency traders, is whether they compete in ways that ultimately benefit investors and our companies seeking to raise capital. As you know, our market structure review is not a theoretical exercise. Indeed, the events of May 6th, which profoundly impacted investors and listed companies, crystallized the importance of this effort. May 6th highlighted the need for regulators to be able to reconstruct the events of a given day across millions of trades, billions of shares, and multiple markets. Today, each exchange has its own unique and often incomplete data collection system, complicating efforts to reconstruct trading activity that can involve millions of records across dozens of exchanges. In response, the Commission has proposed large trader reporting requirements and a consolidated audit trail. This would, for the first time, allow regulators to track trade data across multiple markets, products, and participants simultaneously. We would also be able to rapidly reconstruct trading and quickly analyze unusual market events. Since May 6, we have taken a series of measures to reduce the chances of such an event recurring. For instance, we approved a circuit breaker program that limits excessive price volatility in individual stocks. We approved rules designed to bring order and transparency to the process of breaking clearly erroneous trades. We adopted a new rule to require brokers and dealers to have risk controls in place before providing their customers with access to the market, a rule that effectively bans naked access. And we approved rules to enhance the quotation standards for market makers, including eliminating stub quotes, which represented a significant proportion of the trades that were broken after May 6th. In addition to regulatory responses, we are aligning our examination and enforcement efforts with the current realities of market fragmentation and high-frequency trading. We are making fundamental structural changes in the way we approach and conduct examinations of self-regulatory organizations, including focusing on how SROs surveil for potentially abusive high-frequency, high-quote, or other algorithmic trading strategies. At the same time, our Enforcement Division is investigating whether various market participants have sought to unlawfully exploit the fragmentation of the markets, manipulate the price and volume of securities, or contribute to the market's volatility at the expense of investors. Additionally, we created a specialized market abuse unit to conduct investigations and develop expertise in particularly high-risk program areas. We cannot turn the clock back to the days of trading crowds on exchange floors, but we must continue to carefully analyze market structure issues to ensure our rules keep pace with the new trading realities and to identify ways to improve our markets, provide additional transparency, and increase investor protection. As we move ahead, we look forward to working closely with the Congress, and I look forward to answering your questions. Thank you.
Thank you very much. Chairman Gensler.
Good afternoon, Chairman Reed, Chairman Levin, members of the two subcommittees. I thank you for inviting me here today. I'm also pleased to be testifying along with Chairman Shapiro. I think this is our seventh time testifying together, and at least our third time since on May 6th. The CFTC regulated markets have rapidly transitioned from face-to-face electronic trading now represents 88% of our markets. As a father of three daughters, I've learned much about the new world of Twitter, social networking, and certainly texting. Well, just as we can't turn back that clock, as a father sometimes I might wish to, we can't turn back the clock, which now we have of automated execution, algorithmic market making, and high-frequency trading. The May 6th events highlighted the cross-market linkages that you spoke about between prices and volatility in the securities markets, the futures markets, and other derivatives markets, and it's all enabled by technology. Price discovery, which may first occur in any one of these markets, futures or securities, can then move rapidly over into correlated products in other markets where small disparities in prices arise, even just for milliseconds. Market participants try to profit in what economists call arbitrage between these markets. The CFTC's surveillance program works to promote market integrity and protect against fraud, manipulation, and other abuses. The CFTC is coordinating closely with the SEC on policy level, specifically trying to coordinate with rulemaking implementation of Dodd-Frank, but importantly, we also work very closely on surveillance and data sharing. After May 6, as one example, our staffs promptly shared with the SEC position data and transaction data with regard to that day's events. And the exchanges and the self-regulatory organizations, importantly, conduct frontline market surveillance and also coordinate very closely, not just on May 6, but on many other days as well, and have regular interactions. In terms of data, the CFTC does currently receive futures data on a daily basis. This is most important for us. We get it the very next morning, the open interest and the transaction data. We don't regularly get the order book because we don't have the resources really to get that. May 6, we asked for it. It was 14 million orders. I've just calculated it'd be 476 times more than that stack right there. For that one day in one contract in 1 month, and that was part of why it took a while to analyze that data, but we did get it and shared it with the SEC where they wanted it. We do in our marketplaces, in the futures marketplaces, have what we would call pre-trade risk management functionality. Let's call them safeguards. These safeguards protect against extreme movements. They could be price bands, maximum order size, protection against market stop-loss orders, and importantly, market pauses, sort of timeouts, back to the children's theme, but a little timeout in the market. Exchanges are required to have these, and executing brokers also have to have some pre-trade risk parameters for uses of the clearinghouses for the transactions. Last week, the Commission actually put out a proposal that mandates that markets have pre-trade risk safeguards such as these, but ask the public for their views. The events of May 6 and the Dodd-Frank Act present new challenges, however, and those new challenges, I just want to highlight a couple very quickly, which is our new authorities also give us from Congress authorities to work with regard to disruptive trading practices. The Act prohibits 3 specific things, but we're also asking the public and working on other acts, and we put out an advance notice of proposed rulemaking. The second thing I'd mention is resources, if I might. The CFTC's current funding is less than what we would need to really do the surveillance, not only for the events of May 6, but of course the new Dodd-Frank Act. We currently have about 680 full-time staff. We estimate that we'll probably need about 400 more staff. To put these in dollar terms, our current funding from last year was $169 million. The President's request for 2011 is $261 million. We anticipate we'll have 300 to 400 new applicants that will arrive on our doorstep next summer. These are swap dealers and swap execution facilities and so forth. We have no intention of robo-signing these applications. I mean, we're going to thoughtfully look at them as we're supposed to. We'll need the resources to do that. Thank you.
Well, thank you both very much. And Chairman Gensler, let me thank you, but also I think you've raised a troubling concern, which Chairman Shapiro is also suggesting in her testimony. And Chairman Shapiro, in your testimony, you state, budget permitting, your words. The SEC hopes to hire enforcement staff with expertise in algorithmic trading strategy, market abuse, quantitative analysis, and many other skills you need. According to the numbers in the SEC's fiscal year 2011 budget request, between fiscal years 2005 and 2007, the SEC experienced 3 years of flat or declining budgets, which in effect, with even small inflation, means declines. The net result was that the SEC lost 10% of its workforce and was severely hampered in key areas such as enforcement and examination. And by 2008, I think this became readily apparent to every American with the dysfunction in our marketplace. Even the fiscal year 2010 budget levels, if you stay at that, your workforce is still below the 2005 level, as I understand it. And at the same time, as Chairman Gensler and you both have pointed out, with the Dodd-Frank legislation, there's significantly expanded responsibilities, which we expect you to carry out. So really, for both of you, to what extent are staff levels hampering your ability to improve and strengthen oversight of current high-tech trading, implement the new provisions of the Dodd-Frank Act, and then do what you've both alluded to, try to keep up with the most dynamically and rapidly changing marketplace that we have ever had, from 80% of trades on the exchanges to, a fraction of that today. So let me ask both of you to comment. You can begin, Chairman Shapiro.
Thank you very much, Chairman Reed. Well, obviously resources are a significant concern for the agency. As you rightly point out, we've had a very volatile history of funding at the Securities and Exchange Commission, and while Congress has been very generous in the last couple of years and we've been able to begin to staff up, we are really just now reaching our 2005 levels of staffing and technology spending. And we've been enormously fortunate in the last year to be able to attract tremendous talent to the agency to supplement our already very talented staff. But we're trying to bring in new skill sets, people with expertise in algorithmic trading, people from credit rating agencies and trading desks and hedge funds, to try to help us have the capability to do the job we've always been charged with doing, but also to take on the new responsibilities, as you point out, that we've been given under Dodd-Frank. And it's absolutely essential that we be able to continue to bring that kind of skill set into the agency. One of the most important initiatives for us going forward really is the consolidated audit trail, and I would love to respond at the appropriate time to Chairman Levin's points about how long it's going to take, because we think there's good news on that front. But in order to make use of the data that we would receive from a consolidated audit trail, even understanding that the exchanges will be the primary users of that data, we need people with capacity in data management, quantitative analysis, and the servers and system capability to receive something on the order of 20 terabytes of data in a month. So our needs for both Dodd-Frank and for stepping up and doing what I think the American public has a right to believe we are doing with respect to the oversight of our highly fragmented marketplace, we need significant resources.
Chairman Gensler, go ahead and please.
I thank you for that. I do think that our agency, on a little bit smaller base, we're going to be asked to take on the swaps market, which is approximately $280 trillion notional amount, nearly 20 times the size of our economy, just arithmetically. We currently oversee a market that's about $40 trillion in notional, the futures marketplace, so about 7 times size. We think we need about 70% more people, so we're trying to be efficient. Part of the efficiency comes from technology. We have asked for $18 million more in this coming year, and that's part of the President's request for $261. That is to deal with data. A lot of data will be in data repositories, but we will need to be able to, in essence, put a pipeline into that data and to search it, to analyze it, and to have automated surveillance. Later testimony, I noted that FINRA currently has surveillance tools and alerts on 300 different algorithms. I can assure you we at the CFTC have a fraction of that right now. We only started the program of building our own algorithms in the last 2 years in a serious way.
Let me ask you both, and perhaps this might be a point if you want to comment on the consolidated audit trail, but essentially we're asking 2 agencies who I, again, commend you for your collaboration informally and formally, to surveil these markets, to have a sort of ongoing kind of insights into what's going on. How are you doing that in formal and informal ways? How are you coordinating? And I presume, Chairman Gensler, you have something comparable to the consolidated audit trail that you're trying to roll out. So let me begin with Chairman Shapiro and talk about sort of the collaboration as you go forward. And you might even want to talk about the timetables that.
Sure. The collaboration really has been superb between the two agencies, and I think May 6th is a great demonstration of the capability of the two staffs to work together, understand each other's data, and the interconnections between the marketplace. The Consolidated Audit Trail is designed, would be designed in the first instance to give us a single consolidated set of data with really all the information one could want with respect to the equities markets and the options markets. But it would be our view that over time it should absolutely include all related financial products, so that we should include municipal securities, government securities, and futures that are on equities or equity products, so that we have a truly comprehensive view of the trading of instruments that are economic substitutes for each other. Otherwise, it won't be a very effective system. The initial estimates of the SEC staff when we proposed the Consolidated Audit Trail were quite extraordinary in terms of the dollar cost and the time frame, about $4 billion all in, and as long as 3 to 4 years to implement. We would ask that the SROs actually develop the plan for the Consolidated Audit Trail. The SEC would set out the criteria, what has to be real-time reporting, and what all the data elements are, and they are many, in order to have the information that we need. But as a result of the comment process and our meeting with a number of technology firms, we believe that we can dramatically reduce the costs and the timetable to implementation, because a large portion of those costs, well over half, were thought to be necessary to allow broker-dealers to build the reporting systems to get the information into the repository. We don't think that that is likely to be necessary, and that there are, in fact, technologies that already exist that can be utilized in this space. So we are hopeful that when we come to approving a final rule, the cost and the implementation period will be down significantly, which to my mind would mean we could more quickly bring in all the related products that we think are necessary for this to truly be a consolidated audit trail.
And in that regard, Chairman Gensler, you both essentially regulate economic equivalents of each other in some cases. And you, I presume, have a complementary sort of vision about how you can build something like the Consolidated Audit Trail. And could you comment?
We're fortunate. We have a less fragmented market now. I think in the swaps world it would become fragmented with these execution facilities. By the morning of May 7th, but every morning, we have the full transaction file from the day before in the futures world already in our system, and our analysts are able to analyze it. Actually, on the evening of May 6th, we already knew of the single large trader, this 75,000 contract, and we told the SEC that evening and some of the other regulators that evening, and interviewed the executing broker the morning of the 7th. So we were fortunate in that way. Our challenges are we don't currently have what's called account ownership and control information. We put out a rule this summer, and we very much need to do that. We have the data, but we don't always have the ownership. A second challenge is we don't have the resources to analyze the order book every day. We only did that for May 6th, but it's 14 million orders on one contract. Imagine on the whole market, it's probably measured in the billions of orders. And the third challenge is with the swaps market coming in, how we aggregate the data across the swaps and futures market, and of course, aggregate. I do believe that we have work to do to institutionalize our cooperative nature. It's been a great working relationship, but we won't be there forever, and our staffs will change, and so I think we do have work to do to institutionalize some of this.
But my last comment, you are collectively working on an institutionalization both in terms of technology systems and communication systems as well. People going back and forth, that's going.
Yes, in the midst of a lot of rulemaking.
Right. Let me recognize the Chairman. And then you can go.
Gotcha. Chairman Shapiro, why, since we're talking about your consolidated audit trail and the good news you brought us, give us an estimate as to how much, will it be less than half the cost and half the time? Is that a fair, or is that too optimistic?
Almost certainly any estimate I give you will be wrong, but I will tell you that we think that between 50 and 80% of the current cost estimate is associated with the requirement for the broker-dealers to build the reporting systems, and to the extent there are existing technologies that would facilitate that, it should make a very significant change in the cost level.
Would that be up to half? Or do you estimate? Could it be as much as half?
I would I would hope so. I honestly don't know. But you know what? I also think it's important to point out that while it's a very large number, $4 billion, these are markets that trade $220 billion worth of securities every day. So it's a big number, but there's a lot at stake in getting this market structure right.
Absolutely. That's why we're pressing it. Is there also, would you think it could be done in perhaps less than half the previously estimated time?
I don't know, and I don't want to be misleading in any way because I truly don't know, but it would very much be my hope. I think this is perhaps for me one of the most important things I can try to get accomplished at the SEC.
Okay, thank you. In your opening statements, you both acknowledge that the market prices in each venue are nearly synonymously, simultaneously affecting each other, and that the futures and stock prices in markets regulated by each of your commissions also affect each other. In my judgment, since these markets are so connected, it would seem to me that there's nothing preventing somebody from using one market to manipulate another market. So let's take a look at Exhibit 2, a chart. I don't know if you can see that or not. Turn that around if you would so they can see it unless it's in front of them. Let's assume that Joe Trader was entering orders that he never intended to have executed in one market so that it would move prices to his benefit in another related market. After moving the market price and taking advantage of the price movement that he caused, he then cancels his original orders, allowing the markets to return to normal. Now that seems to me to be a variation of what Trillium traders did, but this time using two markets. My question to you is, might that type of trading strategy, strategy be a manipulation? I'm not asking whether it is, you obviously can't know, but might that kind of strategy that I just outlined be manipulative?
I think it's entirely possible that it could be.
Okay, good.
Because our statutory framework, legal framework, relates to intent, it would depend on the party's intent, but it could be if the intent was there to manipulate a market.
Right. Now, I think you've testified already that since people trade in multiple markets and that that our regulators need to be able to compare the trading data from more than one market to see if trading in multiple markets is being improperly used. Can your agencies coordinated your automated surveillance efforts to spot this type of cross-market price manipulation or anything else that might be appropriate? Is that a possibility?
I would say I think it is a possibility. With the consolidated audit trail, and now again, we have two agencies with different jurisdictions. We would have to ultimately agree to require that the exchanges and the market participants under two separate agencies' jurisdictions agree to contribute data to the same consolidator and to the same audit trail. But I don't know of any reason why, if there's a will to do it and there's the technical capacity to do it, why we wouldn't do it, frankly.
All right. Mr. Gensler?
We already do it. I would say it's more on an ad hoc basis, on an event-driven basis, and an enforcement case-driven basis. And we've had some very good collaboration. I think to do it and institutionalize it might take some rule changes on both sides to have exchanges and self-regulatory organizations on a regular basis from the two jurisdictions being sharing information, and that would be worthwhile to consider.
Okay, if you would consider that, it would be helpful. Chairman Shapiro, do you currently have a automated surveillance to detect cross-market manipulations? Do you have that in place now?
No, we have some tools in place that allow us to, upon request from we request the exchanges to provide us with information, and so we can see activity options markets and equity markets, but we don't have routine capability to see across to other derivative markets, over-the-counter markets, and we don't really have the tools to efficiently utilize the data that we do get.
Now, that's where you hope the consolidated audit trail will help obtain that.
That, as well as the large trader reporting system, which we believe could be in place even much sooner, that will at least give us the capacity to see what larger traders are doing in our market.
Okay, and when do you think that is possible, that large trader reporting system?
It was proposed earlier this year, and it would be my hope that we would be able to finalize the rules and for that, both that and the consolidated audit trail early in the new year. And I don't know off the top of my head what the implementation timeframes are for large trader, but they're measured in months, not in years.
Now, FINRA has a order audit trail system, as I understand it. I think it's called OATS, O-A-T-S. Are you familiar with it?
That's right, yes.
Yes. Is that something which you could use as an interim step?
I think it's a great question, and FINRA has the OATS system, the New York Stock Exchange has the order tracking system, the options exchanges have an audit trail that they use as well. And I think it's kind of a philosophical question almost. The OATS system gathers data. It covers a significant portion of the marketplace. So we could look at whether to spend resources and time trying to make it a little bit better and a little bit more robust and broader, or we could take those resources and time and create an genuinely consolidated audit trail system that's very scalable and very capable of capturing, all the economic substitutes for equities. And so I think what we've said in the consolidated audit trail proposal is we expect the exchanges and FINRA to come to us with a plan for how they are going to implement a consolidated audit trail that gives us all of the data that we need as regulators and that we expect them to use as market surveillors, and leave the choice of the technology to them.
And to kind of summarize what your previous point was and this point, basically at the moment at least you're relying on someone identifying a problem for you first, and then you can look across markets.
I think
at the moment.
I think that's generally true. Either someone identifying a problem, or our own staff obviously sees market activity and may be concerned about a big spike in volume, for example, ahead of a corporate announcement. And then we would utilize a tool called the electronic blue sheets to investigate whether the people who traded ahead of that corporate announcement might have had access to material non-public information and violated the federal securities law. So it's a combination.
Okay, let me just raise a question before I have to run off. How many minutes do we have left? Check on the vote. We're talking about trading abuses here, and I want to just talk about trading abuse. Looks like a trading abuse to me, at least, that involves credit default swaps. Now, they were not subject, those swaps, to regulation before Dodd-Frank came along, and that includes credit default swaps that bet against mortgage-backed securities, and those are the bets that made a major contribution to the financial crisis. Now we got Dodd-Frank, which requires your agency to monitor those types of swaps for a variety of abuses. And I want to give you a description of something that my subcommittee uncovered during our investigation of the financial crisis. I think you have been, or your staff has seen some of these documents that we were able to get to, I think, yesterday, that we uncovered during our investigation of the financial crisis. And I want to get your thoughts as to how either of your agencies could monitor swaps electronically to detect a type of market squeeze. That's what we're talking about. From late 2006 to early spring of 2007, major financial investors have begun betting against subprime-related CDOs by purchasing credit default swaps, the CDSs. Soon the price rose, and no one in the market was willing to offer any more CDS protection against a fall in the value of subprime-related CDOs. Goldman Sachs wanted to continue to buy CDSs, but none were available at a reasonable price. So to change the situation, Goldman's asset-backed securities desk, their ABS desk, decided that it would offer CDS protection at a lower and lower price in order to drive down the market price and induce current CDS holders to sell off their holdings. And when the sell-off was large enough and the price got low enough, Goldman planned to move in and purchase the CDSs for itself at artificially low prices. Now, that short squeeze strategy was described in a number of exhibits, including Exhibit 3A, which I'll start with, which I think was shared with you, and that's a self-evaluation which was done by one of the Goldman traders on the ABS desk who participated in that activity, and will include that in the hearing record at this time. A self-evaluation report by a Mr. Salem, S-A-L-E-M. On page 15 of that Exhibit 3A, at the bottom of the first paragraph, this is what he wrote. In May, while we remained as negative as ever on the fundamentals in subprime, the market was trading very short, in caps, and susceptible to a squeeze. We began to encourage this squeeze with plans of getting very short again, and after the short squeeze caused capitulation of these shorts. This strategy seemed doable and brilliant, but once the negative fundamental news kept coming in at a tremendous rate, we stopped waiting for the shorts to capitulate and instead just reinitiated shorts ourselves immediately, close quote. Now, in an interview with us, the trader who wrote this self-evaluation denied that the ABS desk ever intended to squeeze the market. He claimed that he had wrongly worded his own evaluation report. But his account is consistent with other Goldman documents. In May 07, for example, Michael Swenson, the manager of the ABS desk, who oversaw the trader's efforts, wrote emails in which he encouraged the attempt to squeeze the market. And we'll include these emails, Exhibits 3B and 3C, in the record at this time. In the first email, dated May 25th, this is what Mr. Swenson wrote, and I think these exhibits are in front of you. We should be offering a single name protection down on the offer side to the street on Tier 1 stuff to cause maximum pain. And then on May 29th, he followed up with another email. We should start killing the single name shorts in the street. Let's pick some high-quality stuff that guys are hoping is wider today and offer protection tight. This will have people totally demoralized. Now, when interviewed, Mr. Swenson also denied there was an effort by Goldman to squeeze the short market. He said the purpose behind Goldman's effort was to restore balance to a market that had gone too far to one side, leading to an artificially high cost for CDS protection. But he could not explain why he used the terms he did, cause maximum pain, and this will have people totally demoralized, to describe an effort to restore balance to the market. Other emails suggest that the attempted short squeeze by Goldman negatively impacted its own clients. For several weeks, as Goldman tried to drive down the price of CDS protection, it required some of its clients to make collateral payments to Goldman on CDS protection that they had bought at a higher price. In some emails, clients asked Goldman how they could owe more collateral to Goldman when the clients had shorted the mortgage market, which was declining in value. In the end, short sellers did not offer to sell their shorts at the lower price. Instead, most went even shorter, and Goldman abandoned its efforts to squeeze the market. Even after Goldman abandoned the efforts, some investors were harmed by the lower prices. Now, this is my question. Chairman Gensler first. You're familiar with short squeezes in the commodities markets. Would this type of attempted short squeeze in the mortgage-backed securities market trouble you, number one, as either as a conflict of interest or as manipulation on the part of Goldman? Mr. Gensler.
You sure didn't want Chairman Shapiro to go first? No, in more seriousness, I'm not familiar enough with the facts, and the first time I've seen the document is, of course, now. But in our markets, in the futures markets, manipulation relates to intent and to distort a price. There's a four-factor test that about price manipulation. The Dodd-Frank bill actually, fortunately, I think broadens that, and we have a proposed rollout on fraud-based manipulation, and also Congress has given us additional authorities on disruptive trading practices, all that we'll be publishing rules on and get public comment on that are very helpful. In the current statutory framework on what's called price manipulation, you need to have an intent to in essence, distort a price, and the price has to have been distorted, and those would be the sort of the factors that would have to be applied to this situation or other situations.
All right, and then Chairman Shapiro, let me ask you a question. Whether the SEC has the capacity to monitor MBS markets for this type of activity. Is the capacity there to monitor?
No, it's not there now.
Would it be helpful for you to have it?
I think so, and I do think that we will have better capacity generally with respect to the asset-backed securities markets going forward based on rule proposals we did last spring, but also authorities under Dodd-Frank. But it would be obviously helpful. That's troubling language that you read to us.
Thank you both very, very much, and I'm going to run and vote.
Do you have more questions when you come back? Well, we again apologize for the tag team actions caused by the votes, but one point I want to raise, and it goes to sort of I think the conceptual issue. The presumption, I think, for most people, not perhaps most sophisticated traders in the world, but people who own a few stocks, is that the value of stocks, the liquidity associated with the stocks is directly a function of their economic value. The same thing with debt instruments, the same thing with derivatives, that there is a real economic value here. And one of the issues that we have to deal with is with the proliferation of these algorithmic high-frequency trades. Some of these algorithms don't take into account the fundamentals of the instrument, the economic value, the dividends, or the status of the municipality issuing them. They are simply saying if enough of these are sold, then we start selling. And then if we start selling, another algorithm kicks in. To the extent we get further away from the economic values here, does that not only cause concern, but is that is that something that's good for the economy? I mean, it may be a naive question, but I'll pose it.
I don't think it's a naive question at all. I actually think it's sort of the fundamental question that we're really grappling with. What are the role of traders versus investors, and what kind of trading really provides liquidity to the marketplace that enables investors to get in and out of positions successfully. And when we meet with public companies, and I always ask this question of them, and I always ask this question of retail broker-dealers, how are the markets working for you, for what you need to do, public company in raising capital, what your customers, a retail broker-dealer, are looking for in the marketplace? And there is a lot of concern about whether the price discovery mechanism is efficient, or whether we have the development of two-tier markets that's hindering effective price discovery, whether the playing field is level so that long-term investors who are going to be buyers and holders of securities have an equal opportunity to get the best price in the marketplace as traders do, whether issues like speed and co-location and access to proprietary data feeds so skews the ability of others to effectively participate in the marketplace. And I don't know the answers to all those questions, but they're very much questions that are on the minds of the retail public and on the minds of public companies who really, for whom these capital markets are their lifeblood. This is their capacity and their capability is in these markets to expand and grow and create jobs. So I think these are exactly the kinds of questions that we're trying to explore through our concept release when we ask about what's the quality of the marketplace and what's the quality of our market structure and what are the best metrics to measure that, in addition to looking in detailed questions about the role of algorithms and high-frequency traders and as well as dark pools of liquidity.
Before I turn to Chairman Gensler, one of our roles is to amplify these questions so that they're in the broader context and in the public debate, and also to see if we can drive effective answers, and they might change over time. So I appreciate what you're doing. I know what you're doing, but your efforts, and please ask us how we can be helpful, to find real answers to this that are questions that are posed, as you point out very adroitly, not only by the investor on the street, but large institutional investors, large corporations, et cetera, go really to the nature of a functioning market versus a highly lucrative trading venue. And they can be two different things.
I think you made an excellent point. In the comment process that followed the concept release and a roundtable that we also held back in June to look at market structure issues, one commenter supplied a survey that they had done of a number of investors across the range, and not just investors, but also trading firms and others. And even large institutional investors in that survey, only about a half of them said they felt like the market structure was fundamentally working for institutional investors' interests at this point.
Thank you. Chairman Gantz, your comments from your perspective.
I think that markets have to have the confidence of the public, not just the investing public, but as Chair Shapiro said, the capital formation and the markets we oversee, those that hedge, whether it's a farmer or a rancher in our core roots or the modern financial company hedging a risk. I think that markets for decades have included hedgers, investors, and speculators, and have even included the inter-dealer trader. I mean, in the old days, it was somebody in the pits of a Chicago futures exchange or on the floor of a New York stock exchange. Today, it's in the modern Twitter and high-frequency world, it's somebody with a computer who's maybe co-located and so forth. I think the core that we have to make sure is that these markets, that everybody has sort of an equal access to these markets, that they're very transparent. That's at the core of the new Dodd-Frank bill for the swaps market, but that they're transparent and somebody doesn't have some information advantages, and that we do effectively police them against fraud, manipulation, whether what Chairman Levin laid out as manipulation I couldn't speak to, but we have to police against those manipulations and have the tools to do that.
Let me give you, I think I've asked this question in different words, but succinctly, so much this is cross-market activity, and you alluded to it, Chairman Gensler, and both Chairman Shapiro, your comments. You know, the obvious thing is that arbitrage is something that's attractive, because if you can catch two markets in a quick mixed match, that's usually a profitable exchange. Again, anything that you want to add with respect to the steps you're taking to ensure that cross-market activities, someone who is trading a future to affect the price of an equity so that they can either short or go long on the equity, what are you doing? And then, Chairman Shapiro, what are you doing, or what do you both think you're doing?
Well, candidly, most of what we're doing is within the jurisdiction that we're in, and so there's cross-market arbitrages within the futures market, the options on futures, and then most recently the swaps markets. So we're going to try to work to make sure that we really do have the data set within these markets and can aggregate and do surveillance across those markets, because they can even be in one futures contract between the months that's called a basis trade or a spread trade. I do think we need to do more to institutionalize across the markets as well, but it's within our jurisdiction and then across our jurisdictions.
Chairman Shapiro?
Yeah, I would really agree with that. I think our problem is we have so many markets and we have so many venues where trades are executed that just getting to a point where we have consolidated data about the equity markets would be an enormous step forward. But it would be my hope that we would ultimately have a consolidated audit trail and the capability to surveil across related instruments.
In your concept release in January of 2010, Chairman Shapiro, you said, quote, "Regulation has not kept pace with the rapid evolution of the securities markets," close quote. I would assume you would both agree with that. I certainly agree with it. But there's another, I think, again, perhaps naive, but I think profound question. There is a window to catch up, and if you can't catch up, are we always going to, is this something that will get beyond our capacity to regulate, frankly? And I think it goes back to the issues we've talked about in terms of resources, in terms of personnel, in terms of technology systems, et cetera. But, you know, this is not your father's market or your grandfather's market where it moves at something close to the pace. I'd hesitate to use the Congress as a model, but the pace is much slower than what's happening now. And I must say that one of my fears is that this is a critical moment to not only get up to speed, and so that we're regulating on a near real-time basis or an effective basis, but if we miss this moment, the gap will widen so significantly that regulation will be simply, it will not be effective. It will be there, but it won't be effective. And the second part of this is just this proliferation of markets where you don't even have a perspective into it. You know, comment on those two major points, and then
Sure.
I'll conclude.
I think there are two things that I think are critical. One is the need for regulators to be, as you say, up to speed for the purposes of policing the market, to understand the activity that's happening, where there's abusive practices going on, and our enforcement program is looking at about 12 different kinds of trading strategies that we think have the potential to be problematic. So we have to have the capacity to do all that with the audit trail and with the human and technical resources at the SROs as well as at the SEC. But I think we also have to look at whether there are regulatory changes that are necessary in our marketplace in order to create a stronger infrastructure. We've talked about the things that we've done already with respect to things, relatively simple things like single stock circuit breakers, eliminating stub quotes, prohibiting naked access to the markets. But we also have sort of a menu of ideas, and at this point they're really just ideas, for other steps that we might be able to take at the SEC that would strengthen that backbone of the market structure, including requiring broker-dealers to have procedures that prevent algorithms from behaving destructively in the marketplace, something we saw obviously on May 6th. Whether there should be obligations on market makers to either support the markets or at least not to trade in ways that detracts from the quality of the marketplace. Looking again at the quality of exchange data feeds and whether the public data feed is sufficiently robust in comparison to the one they sell for a lot more money in their proprietary context. We need to assess all the fee structures within the exchanges, the maker-taker fee and so forth. So I think, and we're talking now very actively about migrating the single stock circuit breaker to a limit up, limit down model, which would much more closely actually mimic the futures model. So I think there are lots of things for us to do that will be incrementally important, but important to try to solidify this market structure, in addition to trying to do a better job with surveillance and viewing across all markets the activity that we see.
Chairman Gensler.
I was going to say that maybe because glass is half full, I'm an optimist, and we have certain tools. We leverage off of the exchanges, we leverage off of the self-regulatory organizations, and also the big market participants, the dealers mostly, and what we call futures commission merchants in our world. And we leverage by certain tools. We publish rules. We hopefully update them. They're never quite up to date, but we update them on a regular basis. We use enforcement actions as well. Sometimes they're signaling to the markets when there's a particular bad actor or manipulation and so forth. I think these pre-trade risk safeguards are absolutely critical. I mean, that's why we last week published a rule that included that the exchanges themselves, they've had them in a voluntary way, and the futures market's been very fortunate to have very robust pre-trade risk management, but now that we require some of this pre-trade risk management. So I think we have to always leverage off the market participants and the self-regulatory organizations whose rules, enforcement mechanisms, and as I say, risk safeguards. The last thing we use is transparency. I am a big believer that transparency helps economic activity, but it also helps, in a sense, the regulators, because frankly, you get more people bringing information to you, too.
Well, thank you very much for your testimony, for your great effort at both the Securities and Exchange Commission and the CFTC. Thank you very much, and I'm sure we'll meet again. Thank you.